Hey guys, welcome to Stocks in 5. In this video, we'll be going over everything you need to know about SoFi in 5 minutes. SoFi is a disruptive fintech company aiming to facilitate the average American's personal finance experiences. They provide services ranging from student loans and mortgages to personal banking and investing.
The banking infrastructure really isn't meeting the needs of US consumers. And so what I did was just kind of systematically try to figure out what was broken in banking, and then try to figure out which company was best representative of the solution that people wanted, which I can basically tell you is three things. People want low to no fees, they want fair and transparent lending, and they want a full suite of products so that you can basically have a one-stop shop. And SoFi basically was the top of the list when I looked across all the companies on those dimensions.
That was Chamath Palihapitiya, a billionaire tech investor who highlighted the reasons why he decided to take SoFi public via a SPAC merger worth $8.65 billion. As Chamath mentioned, SoFi's features of having minimal to no fees, being transparent, and owning an ecosystem of products allows them to disrupt the banking industry that still lags behind technology-wise. In fact, 50% of Americans use more than one bank for their finances, and roughly 80% do so due to the lack of an adequate one-stop shop for all their financial needs. This illustrates the large market that SoFi can target in the fintech field. Carrying on with their business model, SoFi isn't only limited at a consumer level with their lending and financial services. SoFi's acquisition of Galileo Financial Technologies enables them to expand their business to other enterprises as well. This is a similar strategy to Amazon's AWS cloud service. Galileo is a software company that supplies payment processing APIs to other fintech businesses. These APIs provide saving and checking account-like abilities for other companies' tech platforms. Galileo API is used by numerous enterprises such as Robinhood and Dave.com to handle their payment processing platforms. As fintech continues to emerge, the acquisition of Galileo can be a great opportunity to diversify SoFi's revenue streams. SoFi is on track to exceed 3 million members in 2021, which is up 75% after 6 consecutive quarters of growth, and Galileo has 50 million accounts across all its partners, which is up 131% in Q3, also seeing 6 quarters of consecutive growth. These are very healthy user growth numbers for a company like SoFi. In addition, SoFi's complete suite of products allows for cross-selling on their platform. This leads to lower customer acquisition costs, thereby strengthening their competitive advantage. For example, 65% of SoFi home loans came from already existing members, demonstrating the effect behind their ecosystem business model. As mentioned earlier in the video, SoFi recently went public via a merger with Chamath Palihapitiya's SPAC. Generally put, a SPAC or Special Purpose Acquisition Company acts as a shell corporation designed to take a private company public without the long traditional IPO process. In our case, Chamath's SPAC, ticker symbol IPOE, took SoFi public. As a result, retail investors such as you and I can invest into SoFi by purchasing shares of IPOE. However, it is notable to mention that the market cap of IPOE stock represents a 9.3% stake of SoFi's total ownership. In consequence, although IPOE stock's current market cap is of $1.89 billion as of recording, public investors who are buying IPOE stock today are investing into SoFi with a valuation of $20.32 billion. We can use this valuation to determine SoFi's price-to-earnings ratio and compare it to similar competitors. Even though PE ratios are often overlooked for tech companies due to their high-growth nature, we can still get some insight into SoFi's value compared to similar businesses such as PayPal and Square. Here's a chart of SoFi's projected EBITDA from 2020 to 2025. As of January 8, 2021, using SoFi's projected EBITDA for this year of $27 million and its determined valuation of $20.32 billion, we can assume that SoFi has a PE ratio of 752.59. It comes as no surprise that in comparison to PayPal's PE of 91.57 and Square's PE of 521.74, we can see that SoFi is trading at a high PE ratio similar to its peers. However, a more suitable approach to analyze a high-growth company would be to look at its year-over-year earnings, revenue, and margin growth. These net revenue and EBITDA charts showcase the explosive growth that SoFi expects to see over the next 5 years. SoFi predicts a very impressive 43% compound annual growth rate of its net revenue from 2020 to 2025. SoFi also expects to grow its three business segments, which consist of its lending and financial services, as well as Galileo's tech platform, to balance out its revenue composition by 2025. Lastly, SoFi's future predictions estimate that the company will be increasing its profit margins year over year, which is a great sign to look for in such a high-growth stock. The last segment of the video, Bulls versus Bears, highlights the major arguments that buyers and sellers would have regarding SoFi stock. Feel free to pause the video to read what both sides of the market have to say. With that being said, I hope you enjoyed the video and thank you for watching.